Welcome back to another live episode of The Educated Homebuyer. This is where Josh and I answer your mortgage and real estate questions right here on YouTube. While we talk about the economy, we talk about fun things like mortgage rates, Josh, and everything
for unlocked borrowers.
and everything happening in the world of real estate. So what's happened over the last week, Josh, since we had our last fantastic live episode?
Well, the big one, we had the CPI figures come out last week, and we had our projections. I think headline was a little bit hot, 0.1 hotter than expected.
Yep.
Core was right where expected. When you look at the underlying components, we'll look at a chart in here. It's definitely moderating. It's funny how market psychology works. The market has concluded that the economy is hot. And every bit of data supports that rates need to go higher. Like, to me, the only thing that justifies the level of rates that we have right now is wondering how the market is going to absorb all
freezing, and we're literally 1 minute into the show.
The best part, Jeb, was your face was frozen, but I heard you talking about being frozen. So we've got the best of all technology here.
I mean, honestly, like, this isn't going to work if we have to do this every week, because I'm going to bail. That said, so Monday, U.S. manufacturing beat expectations. Tuesday, retail sales beat expectations. Today, housing starts and permits beat expectations. Q3 estimated GDP jumped from 3.5 to 4.3 with JP Morgan. The Atlanta Fed is now coming in at 5.4%. I don't understand, Josh, why you can't see the economy is hot and everything is good.
Well, let's talk about what you and I talked about earlier today, is that at the beginning of every quarter, we see these numbers they're nowcasts based off of the data that's available. And I don't fully understand why, but at the beginning of the quarter, apparently that's when all the hot data comes out, because the beginning of each quarter, we've seen the Atlanta Fed throwing numbers out in the fives. We now see JP Morgan or whoever it was saying that. And now, as we progress towards the end of the quarter, we end up somewhere just slightly above 2%. And that will continue trending down. We've shown the charts over and over again. It will continue to trend down. We do not have the recipe for continued hot GDP, but the market trades the beginning of every quarter like, oh my God, the market is on fire. Look at that GDP nowcast. And we have yet to see it play out over a full quarter, in addition to getting downward revisions after the ends of the quarter. So it is what it is. Just got to roll with it. And again, be very defensive. If you're in the market, if you're a buyer and you're under contract, there's really, even the most risk on gambler types, it's just not a whole lot to say potential benefit for not being locked right now.
Wow. That's great, Josh. I'm glad you feel that way. All right, so let's get into some charts like we do every single week, and then we'll start answering your questions. So if you have questions, start putting them in the chat now. We'll answer them kind of in the order that they're put in there. So the earlier you get it in, the easier or the more likely it is to get answered as we get more people in the chat. So each week, Josh, we start with inventory. This week, inventory trickled up a little bit, now sitting at 546,450 homes. I think we gained about 9,000 week over week. Orange County sitting at 2372, Huntington Beach at 185. So both of those numbers are lower than last week. Overall inventory is rising. Why? Homes are coming on the market, sitting longer, not going under contract, because buyer demand is less due to high rates, which we've been talking about for the better part of 2023. National. So this is that same chart that we used to use. Doesn't go back quite as far, but goes back to 2019. Just kind of shows you seasonality in the markets and kind of comparing where we are now to where we were last year, the year before, and even back prior to the pandemic, to give you a little bit of context there. So inventory, even though it's up, it's lower than we were this time last year, and significantly lower than we were prior to the craziness in the market. And new listings are still not really coming to the market, right? That is that dark red line there at the bottom. And the reason for that is most people aren't listing their homes for sale right now, with seasonality playing into it, with interest rates playing into it. People that can stay put are staying put. Inventory is growing merely because less people are going under contract. And then this is that weekly change we took a look at. We went from 537 to 537,000 to 546,000 in inventory. We're now sitting at the peak for the year. Inventory still has not quite peaked yet. Last year, this time we were at 567. So we're still about 20,000 or so short of where we were this time last year. And for context, back in 2015, we were at 1,177,000. And then this is the pending charts that we look at every single week. Newly pending last year was sitting at 55,000. This year we're at 52, compared to 326 total versus 351 total, right? So rates are higher than they were last year, less buyers in the market, so on and so forth. Just less demand out there is essentially what that chart is showing. My mouse froze, so I can't get to the next chart, Josh. So you're going to have to help me out there, buddy.
Maybe.
Are you frozen as well?
No, I got you.
Okay, there we go.
Advanced.
Median list price. Currently sitting at 439. Last year we're sitting at 430. If you remember a couple of weeks ago, we were upwards of 450. So those medians are coming down. The list price are coming down. Again, it's just that time of the year for things to slow down. And again, just rates are not helping the cause, as we've discussed. Price cuts still sitting, still on the rise, sitting around 30. This time was about the time we were peaking in rates, Josh. We were hitting that 7 number. This year, we still haven't quite reached the peak. We're still seeing rates continue to go up. And then that's primarily because volatility in the market. We've talked about it, just different things. The economy looks strong. And, with that, interest rates don't necessarily follow the 10-year, but the 10-year seems to mirror what 30-year fixed rates are doing. And as you can see from this chart here, and we're going to take a look at another one in just a moment, but this is Housing Wire's chart showing bond yields. And this is when it had peaked somewhere around 4.8% or so. We're actually a little bit higher than that, which we're going to see in a chart in just a moment. And then this is showing shelter inflation. Essentially, we've been talking about it moderating, being a lagging indicator. So what are we looking at here, Josh?
It's just Mark Zandi over at Moody's Analytics kind of picked up on this, was running the numbers. It's showing that lag. So the green line, I forget whose data that is, but showing that multifamily rent growth has moderated. But you'll see the way CPI picks it up, there's a big lag. So we didn't start picking up that decrease until early in 2023. And I had the data and somehow missed where I saved it. But if I'm remembering correctly, if you were to look at where we're currently at that green line and put that into the CPI figures, you have core CPI at like 2.2%. That's how big the shelter component is. So what I think we can say, going back to my comment earlier, I don't think the high interest rates right now are any more about inflation. It really is. You guys have heard of the bond vigilantes. They don't want to buy bonds. They're telling the government, stop spending money you morons don't have. But that's where we're at. It really is a supply and demand issue. Demand from buyers of mortgage bonds is less than the supply that our government is putting into the market. When we say mortgage bonds, going back to what Jeb said, mortgage bonds don't exactly follow treasuries, but there's always going to be a premium to treasuries. Treasuries are the gold standard. They are the safest bet that you can make. So mortgage-backed securities will always be a little bit higher, but follow fairly closely. So if 10 years go down, then you will see some buying move over to mortgage-backed securities, and then those yields will follow down. If 10 years go up, you will see people say, why would I buy a treasury or a mortgage-backed security when I get the same yield in a treasury? So it's sort of like a dog on a leash. They're never going to get too far apart from each other, but the treasuries absolutely lead. And kind of the highlighted portion there is something that Jeb has made the point of very regularly. This does not mean that rental prices are falling. They're just growing less quickly. So you're not going to pay less for rent. You're just not going to have as big of an increase. You see we're at about a 2% change year over year. So good news, but it's not magic. It's not great news. It just tells you that the inflation component here isn't really what's moving the market, because Jeb and I are not geniuses. If we can reverse engineer this, the market knows that inflation is not really a problem, and barring energy costs getting out of control because of higher oil prices, unlikely to be. Jeb pointed out correctly in several of his slides there, seasonality. What we saw last year, the weakest months of the year were coinciding with the highest rates, but also at the time of the year when volume slides and you don't see a lot of appreciation. So this tells you that about 90% of the home price appreciation occurs between February and August. So when you see the headlines over the next few months that home prices are flat, home prices not going up as fast, or even home prices dropping month over month, that is to be expected. This is not evenly distributed. So I actually did on our Vetted VA Live last night, we were talking about the concept, is now a good time to buy? And wanted to relate some of the slides that we went through last night here, just showing all of the green arrows are still showing year over year price increases. You do have some markets that have year over year, mainly West Coast, high price coastal markets, markets that were heavily dependent on technology for their economy, and those jobs are not doing as well. In addition to that, you've got Idaho markets, Utah, Colorado, Austin, areas that had really appreciated a lot, people that left California for other Western markets that saw a lot of appreciation. So just wanted to give some context there. And again, we talk a lot here that real estate is local. Real estate is local. So if we look at this, we're going to go, hey, these are the areas that don't have a lot of home price growth. So if you're in Sacramento, if you're in Austin, the ones that comes up, they are really an outlier, down 10% year over year, according to Black Knight's data. But most of these small growth to small decreases. But then we look here, we also have markets here, Hartford, Connecticut, up 12%, Virginia Beach, Virginia, up 7%, Kansas City, Missouri, up 6.8%. So almost everything that you're going to read in the media is national numbers. National numbers don't matter. If you're seeing, hey, that home prices are up 2, 3, 4% year over year, but you're in Austin, that's irrelevant to you. If you see something that, hey, home prices are flat or have dipped and you're in Hartford, not really going to help you when you're out in the market. So make sure you're dealing with a local expert that knows the market and can supply you with accurate data to make your decisions on. Jeb, this is just, again, a different look at that 10-year treasury going back. So 2020, we all know what happened there. COVID hits. We were already at low yields, somewhere around 2% on the 10-year treasury, got down under 0.5% and basically traded sideways through 21. And even though the 10-year was going up throughout 21, or at least through the first half of 21, it took till the start of 2022 that we had the big run up. We had a big run up, a little correction in the middle of 2022. And what you were talking about, Jeb, here is from July-ish of 2022 through the end of the year, we had this big run up. And then we had a nice correction in the earlier part of the year and traded sideways. And here we are again from about May of this year, a big run up. Now, if you look at those blue lines that we drew there, just a long-term trend channel, we're at the high end of that. So one of the things, Jeb, that we always talk about is float when you're at the top of the channel, lock when you're near the bottom of the channel. Well, it's been 2 years since we've been anywhere near the bottom of that channel, but it really is telling us here that we should be at a near-term peak. The actual absolute number there, I think, is about 5.25 on the 10-year treasury, which is about 0.25% higher than where we are right now. Another look at this is just kind of what I was saying. Run up late last year, decrease early this year. We're seeing a similar run up, and then Mr. Question Mark eyes there. Are we going to see another run down?
What scares me is that if we go back to that chart, we haven't hit that top trend line. That is what is concerning, right? Is that there's probably room to still move up before you see that pullback. Hope Absolutely. Not for any meaningful pullback, but
it doesn't. So you're right. It does not have to hit the top, but it is likely that it will, at least a very good chance. We have a little bit of resistance at 5.0 on the 10-year. And after that gives away, you're really looking at 5.25. So it's about 1/4 to 3/8% higher in rates than we're at right now. And this one, Jeb, is the big headline that I'm sure everyone saw in their Google feeds popping up. 30-year fixed rates hit 8%. Best qualified borrowers are still going to be under that, but the majority of folks, or anyone with slightly lower credit buying a non-owner occupied property, absolutely going to be up in the 8s at this point.
No, and with that said, Josh, I will be the first to admit I was wrong. I did not think rates would be at 8%. It's funny. A buddy who watches the show and a client of ours, we're texting today. I talked to him about business. He deals with a lot of big businesses. They do concrete work, and for big companies, Disneyland, and Universal Studios and all of these. And he's essentially said, like, anybody that could put things on hold has put things on hold. Anybody that is already under contract, they're already doing work, the bids were already did, that stuff gets completed. That's just how it works. But any new work that's done, it's not happening, because these businesses have people forecasting the economy. They know what's going on, and therefore they start to tighten their belts as things happen. And it's a matter of time, but it's so crazy to me that none of the data at the moment is showing any signs of weakness. I mean, it is pretty remarkable that we're talking about numbers continually beating week over week. That's all I got. Are you frozen?
We're going home. We're done. That's tonight's conversation.
No, I just didn't know if you were frozen over there, because that seems to be the norm over here. How many times have I frozen?
A couple times.
Couple? That's great. That's fantastic. All right.
Your wife's looking for one of those pause buttons in real life.
It's right there, man. Just hit it. Just hit it. That's it, guys. We are here to answer your questions. So start putting your comments in there. We'll definitely touch on them if we can. The goal here is to answer as many of these in as quick a time as possible. We're here for an hour, but I do want to plug a couple of things. First of all, those who follow the podcast that listen to the audio, everything was good. Audio was posted yesterday. Those of you who follow the podcast on YouTube, I apologize. I put the video for next Tuesday to be released instead of yesterday. So when I found out yesterday about midday that it wasn't released, I had to go in and change it. So we released it today. So it was a day late. Any hard, podcast listeners to the audio or the video, I apologize. Jeb's fault, 100%. But it is up there. But if you haven't listened to it, it's the idea of, will millennials be able to buy houses with housing affordability being where it is, with house prices where it is? What's the story look like? What has to change? So if you're interested in that at all, go check it out on the podcast, on YouTube here. And if you find any value in it, hit the like, subscribe if you haven't done so already, rate us and review us on the podcast. And here on this channel, if you find value in that first 15 or so minutes and you haven't done so already, hit that thumbs up. It helps the algorithm, helps push it out to more people, and helps us do what we're trying to do, which is help become or create rather more educated home buyers. So Josh, this question came in prior to the show ever starting. And it's something that's floating around out there a lot. And for reasonably so. But Torio 213 says, regarding the Remax lawsuit settlement, do you guys think that will affect the home buying process and make it more difficult for buyers? So you and I were kind of talking as we came on the air, because the question was there prior to us having this conversation right now. And so the idea here is that, and for those of you not following, what happened is essentially it's some of the National Association of Realtors has always basically required some sort of payment to be put in the buyer's compensation or the selling agent's compensation. That's the one representing the buyer when a property is input online, if you will. So if you're a buyer's agent and you're helping a buyer buy a property, essentially the commission that was being paid to you 99 times out of 100, maybe even higher, 99.9% was being paid by the seller. The seller, in theory, was quote unquote required to pay that commission. Okay. But typically what happens is a seller offers a commission, and then the listing agent and the buyer's agent split that commission, or it's divvied up. So, but there was a requirement that there be something there. The lawsuit basically states now, or as a, it goes into full effect, is that the buyer's compensation is no longer the seller's responsibility, is more or less what it is. So the question, Josh, is how will that affect the buying process? I'm throwing that to you. I have my thoughts, but let's hear yours.
Yeah. So think about it. People don't really understand how it works. There are commissions for both realtors involved in the transaction. Right now, what consumer advocates are trying to say is they're inflated because they're transparent to the buyer. You're paying it and you're financing it in your purchase price, but you don't see it. You're unaware of it, can't negotiate it. And with that, they're trying to unbundle it and say, you're going to be responsible for paying your own agent. So they, okay, cool. That might lead to lower fees, but so let's say that it does. Let's say that instead of your buyer's agent making 2.5%, they make 1.5%. But you have to come up with the 1.5%. So you got to pay 1% less for the home, but it comes out of your pocket. We've run through the numbers of what it costs per thousand financed onto the loan. Jeb, it's just, I don't see any way that this benefits buyers.
I look at that, Josh, and I say, if I'm a seller, if you're a seller and I go to you and say, for example, the last house that sold in your neighborhood was $1 million. And we go to you and you say, what's my house worth? And I say, well, the last close comp, very close. It's $1 million. And we talk about commission. What's the commission needs to be paid? Well, this is typically how it works. My fee is say 3%. Let's just say 3%. Am I required to pay the buyers? No. In this case, you're not required to pay the buyer's compensation, right? I recommend it, but you're not required to pay anything. So you're paying my commission. Nowhere in there did you reduce your price or say, I'm now willing to take less money because the buyer's compensation isn't part of my fees. That's not how people think. A seller is not going to say, okay, so I'm not paying the buyer's fee now, so I'll just take less money or I'll negotiate a little bit more. No, that's not reality. And so I don't see how this changes. The seller is going to net more money, but the buyer isn't getting a deal or getting a house for less money in this instance, in the way I look at it. Am I wrong?
Well, in the short run, that's absolutely correct, because no one's going to go, oh, I'll sell mine for less than the last guy because I'm paying less in commissions. In the short run, no change. Over the long haul, you would think it would adjust and the market would absorb it and get used to that. But I don't mean long haul like 30 years, but 3 years, 5 years, 7 years. So it's not going to happen overnight.
But here's the thing. When you have an agent on the other side that says, like me, for example, I say, hey, listen, if you want to attract more buyers to this property, I would recommend you pay a buyer's commission. It's going to net you more money. So every seller is not going to participate in this thing. Some sellers might, right? But I would say the sellers that understand how this whole thing works are less likely to be a part of that. That's the way I look at it. If you're looking to maximize the price on your house, you need the most eyeballs on that property. How do you get the most eyeballs on it? You pay a commission where people are incentivized to show that property, to want to sell that property, to do those things. Am I wrong? Maybe, but I don't see a world where this becomes 100% the new norm.
It's a major change, and it's always great for someone to have a theory about, hey, we're going to save a couple nickels here for buyers. But even if it did, let's go back. Say the proposal that I saw is, okay, let's say now that buyers agents are getting 1.5%, 1%. Median home price over 450,000. So we're talking at the entry level, $4,500 on entry level here in Southern California, $10,000. Most of my buyers don't have the money to pay it out of pocket. So I don't know how that's going to work or how that's going to benefit buyers. And anytime you have a systemic change that's proposed, when you get closer to the rubber hitting the road and people saying, oh, wait, that's not so awesome. We'll see. We'll see how it all shakes out.
Yeah. What happens is the buyer ends up going to the listing agent in that case, because the listing agent's already making money, and now the listing agent goes back to the seller and says, hey, listen, like, now I'm representing two sides. We've got to figure, I'm working double. I don't know. I don't know, because it's not all 100% laid out. It's going to hurt buyers at 100% in the short run if it becomes the norm, at least in my opinion. Logical Thinker, one of our old school viewers here, says, when you guys purchased your first primary residence, what was your DTI? What is the average DTI you're seeing right now for first-time home buyers? So Josh, I have no idea what my first DTI was. No, not even close. I have no idea, no recollection of what it was. But what are you seeing for first-time home buyers?
Well, neither of us, I mean, even if I saw 15, 20 closings a month, that wouldn't be enough. And it would all to give you a realistic number. And geographically, we're always going to be skewed higher here in Southern California. So the data from Black Knight is showing mid to high 40s. So basically at the high end of what is possible under the current underwriting guidelines. And that's up from like low 30s as recently as 18, 24 months ago. So from that perspective, is the information for Jeb or myself going to help you? Probably not. But let's just say I bought my first condo in 97. I was making pretty good money at the time. Rates were higher, prices were lower. So ran the numbers somewhere around 15% on the housing to income ratio. And when we bought our current house in 2003, more expensive home, lower interest rate, making better money, it was somewhere 18-20%. So again, doesn't really help anyone looking at the market today to know where Jeb or I were at. I can tell you this. Talk to some folks today, their comfort level, very well qualified, first-time buyers, young folks, both of them make about $125,000, so $250,000 annually, a little over $20,000. They're going to be somewhere in the low 30s. So payment's still very high, but for them, the relative amount of that payment, not bad at all on a percentage basis. Do I talk to people all the time that are at 47, at a 49? If we're on an FHA and we're talking all debts in and they're at 57%, we've talked on the show before, VA loans up at 60, 70% debt to income ratios. All of those things are possible, and it is happening in the current market, but it also happened in the previous market. The one that Jeb and I talk about, his buyer that we did the 68 or 69% debt to income ratio, that was in 2019. Before everything went crazy.
Is that when it was? It was. I thought it was earlier than that. I don't know.
It was before COVID. We know that.
It definitely was that. P-Town. It doesn't really have a question here, but just says, I FOMO Panic Bot in April of 2022, just outside Seattle, and landed a 4.3% APR. So if it's an APR, that means the rate's lower than 4.3. $775,000 for a POS. Really sucks, but based on the numbers, thank God we won the bidding war to get in first-time home buyer. So yeah, it's all relative, right? Hindsight is 2020. That said, I really wish I would have locked in last week. I did not. So here I am looking at the market going, what do I do? Do I gamble? I'm gambling, baby. Just whatever. Rates are going to come back down. I'll refinance. What the hell? I'll take an 8%. Let's make this happen.
It's not a matter of if, Jeb. It's a matter of when. When could be 20 years from now, but it could be 20 months from now.
Good. Willing, when does it make sense to refinance? Is there a rule of thumb for how much your rate should be lower to offset the closing costs? Are closing costs less for refis compared to purchases? So you have a rule of thumb about dividing the loan amount into or dividing what? 250 into your loan amount. Is that right?
125,000. So actually we have a follow-up question here from someone else that actually we have a example that we can use. So Russell says, my sister bought in February, 30-year fixed at 5.85, borrowed 1 million, wants to refi as soon as possible. How soon do you think she can refi? Again, Jeb and I don't have the greatest of crystal balls here in terms of telling you when rates will hit there, but what would rates need to be for it to make sense? So let's use that rule of thumb. Take 125,000, divide it by her $1 million loan to make a significant enough difference in that monthly payment for it to be worth her while. It's only 0.125% in the rate. So 5.85 down to 5.7, 5.6 would absolutely make sense. Now, most people, despite the fact that it's making financial sense, will say, I want to see a quarter, 3/8, 0.5%, even with $1 million loan, because there's work and effort that goes into this. But in terms of smaller loan amounts, you obviously need a much bigger difference. If you have a $250,000 loan, 125 divided by 250 says I got to move 0.5%. And people ask, why does this work? Why is this magic? It's not magic. It's just when you run the numbers at a $250,000 loan, if you lower that interest rate 0.5% and show the person, hey, here's what your monthly savings is, most times they're going to go, yep, that's good savings. I will take that. During, the pandemic, we had people that would reach out here on the show and say, hey, I'm calling everyone. And they're saying, this doesn't make sense for me to refi, but I'm at 7%. You have a $40,000 loan. So we take 125,000 divided by 40,000, you get 3% savings to even make it make sense, because it's accounting for the effort on your part, the closing costs, and what goes into that. So your closing costs on a refinance, you can do them no cost and take a slightly higher interest rate. And at that point, you have no recoup period on that. You're to the positive from the first month, but you generally want to look at closing costs anywhere from $2,500 to say $4,000, depending on the loan size and whether you need an appraisal. You want to look at that, say, what are my monthly savings? How quickly do I get to the positive? So on top of that, Jeb, the last piece, that's a rule of thumb when the numbers make sense. I always like to show my clients Let's say, Russell, your sister comes in here in 3 years. She only has 27 years remaining on that loan. I like to show them a 27-year loan term because our goal is to get to a freedom point with that home where we either have enough money to pay it off or we have paid it off. And the best way to do that is to not keep resetting back at 30 years, not take cash out of the property, keep moving towards that payoff date. So want to look at calculating when it makes sense, but also making sure we're not stretching out the payoff date.
No, good stuff. Good stuff. So, SNN Media says, in the current market conditions where variables are constantly moving, how can a buyer know what the true value of a home is? What are the indicators to know if a house is at the right price or overpriced? So it basically comes down to comparables. But in a market with little activity happening, with little demand, smaller demand, it's a little bit harder to kind of figure out. But what I will say is that in a lot of markets out there, due to low inventory, prices aren't budging a lot, right? And so it really comes back to location, and not location just nationwide, but location within your city, that sort of thing. So you got to kind of look at all the variables, but look at comparables. I mean, that's really what you're doing. Try to stay up to date. Don't be looking at comparables from 6 months ago. Look at comparables that have sold within the last 60 days, 90 days. And try to look at it like that. And where we are, homes are still selling for a pretty good price. I mean, I haven't really seen things decline very much, if at all. I mean, I listed my home on the market, got a couple of offers, and I pushed the price. What I felt like I pushed the price a little bit, and no shortage of people not willing to jump on it. I mean, clearly a shortage, but because it would have been a lot more had the market been demand had been higher. But it's impossible to say without knowing everything going on. But I would just say, pay attention to the most recent stuff out there. But that's really what it is. What is somebody willing to pay for it? What are you willing to pay? That's that, and what is the seller willing to agree to? That's what you got to figure out.
Go back to the definition of market value. It's what a buyer and seller agree to in a free and open market with all relevant information available. So no one has all of the information, but in our market with an MLS, with most of that listing information syndicated to Zillow and Trulia, we're as close to that as we ever have been. So it's just important to remember that anyone saying, oh, these homes are overpriced, or, hey, I got a steal. If the home was listed in the multiple listing service and marketed well by a realtor, it probably sold at what the market determines its value is today. Doesn't mean it's going to be the same 6 months, 12 months, 24 months from now, but that's telling you what fair market value is today.
No, agreed. Let's see. You've got a lot of questions around rates. I mean, I understand why. But Billy says, my landlord is willing to sell his house to us, but we don't qualify for the whole value, about 200,000 to 300,000 short, but he is willing to sell it to us and pay the difference in 3 to 5 years. How does it work? So typically what would happen, Billy, in some instance like this is there would be some seller financing, some silent second, something on the backside of the transaction that shows that you still owe them money. You need to figure out, are they charging you? Are you being financed? Is there a rate on that 2 to 300,000? Is there any additional payment due? What happens in 3 to 5 years if you can't pay it? There needs to be some terms set out there so you fully understand what you're getting into. But that's essentially how it works. Josh, anything you want to add on that?
Yeah, because it all comes back to the ability to repay. Fannie Mae guidelines, FHA guidelines, VA guidelines, USDA, they will all allow a seller carry for you, but it has to be at market terms and there has to be a payment calculated. So if you don't qualify, you don't qualify. We can't just act like that additional $200,000 or $300,000 doesn't exist, because the lender knows at some point there's going to be either a balloon or a payment that comes due. So even if the seller says, I don't want any interest, I don't want any payments, in 3 years, you owe me this money, it can't be ignored. There has to be a payment calculated for that. It has to be at market rates. So what's a market rate? what is the best available rate on a second mortgage right now? 7-8%. So you're looking at still having to calculate a payment and qualifying for it. Unless the seller is willing to carry the entire loan, then whatever the two of you agree to can be done. But if you're needing institutional financing for your first mortgage, we can't just ignore that you have a $200,000 or $300,000 second loan.
There you go. Tony, another one of our regulars here, says, do you think the Fed will raise rates again at the next two meetings, or will they let the lag effect take place and see how the economy is really running once the first of the year comes around? So impossible to say for sure, right? The Fed has been pretty transparent for the most part about their plans. And most recently, they've kind of alluded to the idea that high bond yields are doing their work for them. It's keeping the economy restrictive and, less likely that they'll do it because of where yields are. But I don't think nothing is 100% off the table. I don't know where the Fed probability chart is today. Josh, I'll look it up real quick here while you want anything you want to add to that?
Well, if you look, our best insight into this is what have the Fed's members when they're out on the speaking circuit been saying. So it's been a pretty consistent drumbeat for the last 10 days.
96% say we stay where we are at the November meeting.
And what's December?
December is 62% that we stay where we are. 36% says there's a possibility of a quarter point hike.
So if you look at that, I think that's mostly being impacted by nearly all of the Fed speakers out there saying, hey, we are enough restrictive that we have some time to sit back and look and see how this plays out. And I think it relates back to all the things we're saying. They're looking at the data that will be coming down the line in 2, 3, 4 months in terms of inflation and seeing that inflation is not the problem. And we've talked about this before, the Fed does not control the actual rates on treasuries. They control the Fed funds rate. But when treasuries and when mortgage-backed securities get sold, buyers and sellers of those, the market determines the price. So what we are seeing is that is getting restrictive. The cost for mortgages, the cost for government borrowing, that will continue to be restrictive regardless of what the Fed does. So I would be really surprised. I wouldn't rule it out. I think that the futures market has it pretty correct. They're not going to do anything at the next meeting. There's a chance they do at the meeting after that. But think about that. We're at October 18th. We've got 45 days before that second meeting. There's going to be a lot more information coming out. And as we said earlier in the show, early in the quarter, for whatever reason, a lot of the data that comes out is hot. I expect we're going to see some significant softening before then, and the Fed's probably going to stay out of the way and let this sort of play out.
There you go. Joyce is asking about HELOCs. So Josh says, she asked how HELOCs work. So good news, Joyce. We actually did an episode on this on the podcast, the Educated Homebuyer Podcast. It's a separate channel where you can go watch videos on HELOCs, all the information you need to know. There's also audio. If you just want to listen to that, you can find it on Spotify and Apple. Same name, the Educated Homebuyer. So with that, Josh, if they bought a house today, could they use a HELOC to buy another house in a few years?
Well, what do we mean by use a HELOC? To access some of your home equity for the down payment? Yes, that can be done. You wouldn't really use a HELOC as your first mortgage to buy the property. So when we hear this, just actually closed a HELOC for a client today. They took $300,000 out of a house here in California, and they're buying a home in Nashville. So is that possible? Absolutely. Is that going to be the best move or the right move for you? Depends a lot where interest rates are. If we end up 3 years down the line, you have a 7% first mortgage and interest rates are 5.5%. That time, you'd probably just do a cash out refinance to access some of your equity.
Good stuff. Go ahead. Were you saying something?
I was just going to say, in terms of the HELOC, while Jeb's talking, I'll post a link to the YouTube video of the podcast episode.
Okay. This one just says, assuming interest rates stay high, 6, 7, 8% for the next 5 to 6 years or more, will that affect those with adjustable interest rates today? It could. If interest rates were to stay high for that period of time, I don't think it's likely, but again, anything's possible. It could affect those that got in with 5-year ARMs, in less than 5 years. But I think that the likelihood is that rates are lower at that point and would allow them to refinance. Those that got rates today in 5 or 7 years, if rates were the same, it really wouldn't affect them, right? They would just essentially refinance into the same rate or just allow it to adjust, in which case nothing would really happen. They would just be on that adjustable until, they did something to fix it. So again, it's one of those questions that's really hard to answer just because you don't know where things are going to be in 5 or 6 years. But, rates rarely stay within, a 2-point range for that long of a period of time. You see some sort of fluctuation in one direction. And based on where the economy is now, my guess is that you see lower before you see significantly higher.
Jeb, while we're on the topic of interest rates, there were a couple of comments here. People saying rates are going higher. They're going to get higher. We're going to go double digits. We're going to be at 12%. People are real cavalier when they say things like that, and they don't think this through of what that would actually mean. The average maturity on government debt, so all treasuries in issue, is about 6 years. So in 6 years, the majority of government debt will roll over. So let's go back 2 years. Most of that government debt is sub 1% or in the 1% to 2% range. So we haven't even begun to feel the smallest bit of the hit of higher rates to government spending. You may or may not have noticed, but we have almost a $2 trillion annual deficit. If we were to keep rates at the current level, forget 10 or 12%, if rates went to 10%, which we're at barely 5%, not even yet to 5% on the 10-year treasury. So to get a 10-year mortgage rate, you'd be at 7%. You are talking a tripling of interest expense. Do some research, go and Google that, see what that does to the government. You might say, I don't care. It just is what it is. That's where it's going to go. If you don't think that's a massive, catastrophic, depression level event, you don't understand economics. So it sounds fun to sit behind a keyboard and say things like, yeah, they're going to go to 10, 12%. It's just the way it's going to be. We have never had 30, 40, $50 trillion of government debt. And over the last 20, 30 years, while the government has been racking up this excessive debt, they haven't felt the pain because rates have gone nowhere but lower. So interest expense has not increased. So again, the idiots in Washington, D.C., continue to spend more and more money because over the last 20 years, there's been no pain to spending the money because the credit card bill that comes due every month is the same. That will not be that way in the future. So you have to think one of two things. Either you're wrong and rates will go lower in the next year or two because the government cannot afford its debt at current interest rates, or you're looking at a catastrophic level event for the U.S. government. Those are really the only two options.
No, good stuff. I mean, that's really important. I mean, that's one of the more important things we've said in a very long time. Something to really hone in on when you're thinking about long term here. We got a question here that's kind of out of queue, but I'm going to push on it just because this bugs the hell out of me. Not the question, but the idea. Just says you guys should upgrade to business class internet or have the internet provider change your main line and outlet. Well, guess what? We've done all of that. We get 2 gig upload and download speeds here. Do you realize how fast that is? And yet we can't stream on YouTube from here. It is mind-boggling. We've had people come out here and change the router. They've changed everything. Everything is fine, guys. It's like the federal government. Our internet is like the federal government. They come out and they go, everything's fine. Everything is perfect with the economy. Everything is perfect with your internet. Little do they know, we're barely getting by over here with the internet, and so is the government. So keep that in mind, guys. Anyway, I move on. I digress. We got a couple questions on builders, Josh. I'm going to kind of throw all these together because I think they make for kind of, interesting conversation around builders. Hello. Why do builders offer a lower interest rate than regular lenders? And then we have a question. Where was it here? Did we lose it? Where is it? Oh, this one from Ed saying, I'm 30 days out on closing on a new build. Appraisal came in higher. Lender has suggested to ask the builder to raise the list price and use the equity in buying down points. Good idea. So builders are able to offer lower rates because they have margin in on the deal, right? So a builder can say, builders aren't in the business of holding on to homes. They're looking to sell them. They have a profit margin in there. And when things like, happen right now, rates are high, in order to get those properties off their books, what they do is they offer incentives. They can offer incentives a lot of times because they own the mortgage company too, or they have ties into the mortgage company. But what they do is they take some profit from one place and give it to another place in order to make it look, more incentivized for a buyer. So they're offering credits. They offer, credits to buy down rates. That's how they offer lower rates. Sometimes, as Josh has mentioned, they're able to go in to these bigger lenders and get pricing at a lower rate because they have so many deals that they're putting together at one time. That could be a reason that happens as well. Josh, you might have something you want to add on to that, but I wanted to kind of throw that second question to you about using the equity.
Just some context to the numbers. Builders' margins over the last few years have decreased from 30% down into the low 20s. So if we say a median home price on new construction is $450,000, a $450,000 home with a 20% margin, there's $90,000 of profit. Giving up $8,000 or $9,000 to buy down your interest rate is a small cost, and it's just a cost of doing business. It costs them much more to keep that on their books with their construction loan for 3, 4, 5 months versus essentially putting a sale price on the home in the form of a lower monthly payment to get it out the door. When you're buying from a private party, the private party doesn't have that margin in there. They're looking to maximize every dollar. So if there's high supply and low demand in that area, a wise seller may look at doing the same thing. Here's 2 points. Go buy your interest rate down. Jeb also nailed it on the other piece is a builder knows, hey, we're going to have 100 units available between this 60-day time frame that are all going to close. Most of them are going to be conventional. There might be a few FHAs. They can buy forward commitments and also push the rates down lower on that.
All right. So another question, going to address it here. Burn It Up says, have you changed your equipment? Could be the bottleneck due to low specs. Well, the good news is both of the video cards here both support 4K. We can't even stream in 4K. We're in 1080p. So in theory, everything is good. And quite frankly, we never had this issue until we went to the faster internet. So I don't know what the hell is going on here. So, but yeah, we clearly have problems. I can do this from home, and I only have 1 gig upload, download, and don't have these issues. So, if you're an internet service provider, we're waiting for Google to get their satellite up there and we can just connect to it.
Yeah.
Like Starlink. All right. So, Josh, Matt's getting his real estate license, no longer needs our help. He's here learning, taking his knowledge, and is going to apply it to his clients in the future. So, congrats there, Matt. I would recommend a crash course prior to the real estate exam. The reason I say that is because nothing you learn in taking those tests is actually regarding real estate for the most part, other than the finance side. Most of it's all legal stuff. If you're going to be like an attorney, a lot of that stuff you need to know. If you're going to be a real estate agent, 99% of it you don't need to know. It's never going to come up. But crash courses are good because, it's question answer, tell you how to beat it every time.
Jeb, you got so mad about the internet that we never actually answered the second question, Ed's question. 30 days out from the new build, appraisal came in higher. Lender suggested to ask the builder to raise the list price and use the equity in buying down points. A couple of pieces here. Not sure the lender is going to be in a position to do that. When the appraisal is ordered, we provide a copy of the purchase contract. So now that the value came in higher, can we edit it? Can we change it? Possibly, but there might be an issue there. The appraiser may look at it and go, why is this changing now? If the file's already been underwritten, the underwriter might be asking why. You probably can do that, but it's just something to be aware of. The second piece of that then, Jeb, is that the wise use of equity? If that is the true market value, what it appraises for, are we better having equity in the home or are we better having a lower monthly payment? That largely depends on what you expect the future trend for interest rates is. If you think rates are going to stay here or move higher, then having the lower interest rate for the next 3, 4, 5 years would be the better move. But if you think rates are going to move lower in less than 5 years, I would recommend keeping your hands on your equity.
Good stuff. Good stuff. Willing is asking if I'm planning on growing a beard in November. My goal is to go.
Didn't even wait.
I'm not shaving until interest rates get below 6%.
I like this idea. We're going to see Rip Van Jeb here in a second.
Dude, I'm going strong. I'm going through the end of the year for sure. So that's another 2.5 months. So we got 2.5 months. I mean, this is going to get out of control, guys. But I'm willing to sacrifice for lower rates. That's what it comes down to.
I like it.
But yeah, let's see what happens. I should shave my head and do it. Do both. Anyway, this is a good question from Christina. Says, is it worth it to put 20% down to avoid PMI and escrow? Josh, we've had this question a lot. I really don't want to have escrow. So explain the question here and your thoughts.
So you don't have to put 20% down to avoid an escrow impound account for your taxes and insurance. If you put less than 20% down, you will have mortgage insurance, and they will collect that monthly and escrow that for you and make those payments onto the mortgage insurance company. But if you're putting 10% or more down, you can avoid, or you can choose whether or not you want to have your taxes and insurance impounded. Some lenders charge for that, so you may pay a quarter point worse in fee, not in interest rate, but most nowadays give you the option. They don't really care. So when you look at that, just ask your lender to walk you through what mortgage insurance would cost. Do you qualify with 10% or 15% down? And then how much is the mortgage insurance? Most people are shocked when you get to 10 or 15% down. And if you have good credit, it's a pretty minimal number. So then we ask the question, am I comfortable with a payment being $75, $175, $220 higher, and having $5, $10, $20, $50,000 more in the bank? Personal question, only you can answer it, but have your lender quantify it for you, what the mortgage insurance and the higher loan amount is going to increase your payment. And then do you value that money in the bank more than the lower monthly payment?
All right, good stuff. Let's see here. All right. Let's Willing had a question about using a 1099 income with only 1 year of history. Josh, I've seen that done before, going LP, so going a different direction than typical desktop underwriter, just using 1 year, right? Or is that
LP will only allow 1 year if you've been in business for more than 5 years. So Freddie Mac's automated underwriting system defaults to how long you've been in business. What she's saying is someone was W-2 employee and then goes over and starts a new business. So DU, Fannie Mae's automated underwriting system, might give you 1 year findings. They might not. So if you don't get 1 year findings through DU, or you're doing an FHA or a VA loan that requires 2 years of tax returns, the guidelines say 2 years. If you're in a similar line of work and you have at least the 1 year, you may be able to get that approved with a strong file. And the reason for at least 1 year is 1099 income. We have no idea what the expenses are. You know that the business generated X number of dollars, but you don't know how much it spent to generate that and what the net income is to the business owner. So we need at least 1 year, but it would absolutely be an exception unless you were to get 1 year findings on DU with the automated underwriting.
All right, good. Matt just followed up and said he's definitely doing some crash courses. No crash course, just one the weekend before you take the test. That's it. All you need is one, and you'll be good, assuming that you've done some basic studying of the stuff.
They pour the information in your head, and then you go and just spew it out.
Yeah, I mean, it got to the point. I think I took one on my brokers, and it was literally like by the time I got there, I could read a portion of the question. I already knew the answer. I mean, that's how it was done. Kaiser with a question about how do you think an Israel-Hamas war might impact interest rates? So, Josh, I'll tell you my thoughts. I thought we would have seen a bigger impact on 10-year and rates than we have already. I don't know if it's just because we haven't seen the progression that I think maybe they thought was coming yet. But the thing now is that Biden came out and basically talked about additional spending, I think, which made the market kind of go the other direction that, and send bond yields higher. So maybe you can elaborate a little bit.
The bond markets, the bond vigilantes, and just the average American has had enough. There's no more money. There is no more money. So we can always find something that is a moral or righteous cause that people will feel like, hey, we need to do that. We need to support that. But I think more than at any point in my 50 years on this earth, most Americans are just like, hey, let's take care of our business here. We're not doing such a great job with America. Let's focus on here. So yeah, you saw them talking about additional funding for Ukraine, additional funding for Israel, and you start going, cool. It's not like we got money sitting over in the bank to write checks for these people. You're talking
We don't need it.
about
We just print it, Josh.
issuing more treasury debt that is already at record high yields for the last 20 something years, because we don't have it. So it'll be interesting to see how it shakes out. I think our politicians of both stripes are completely tone deaf and think they can just go and say, hey, we got this wonderful thing that we need to support, and we're going to go issue a couple $1 trillion more debt to pay for it. And most Americans are like, no, I'm cool. Let's worry about us and figure this out here.
All right. Hinius ask a question that you kind of addressed earlier with the new construction or the new building question, but says, is it a good idea to go up in price if you're doing a 2-1 buy down? So what I could say is if you can do it without going up in price, that's even better, right? If the seller's willing to give you a credit towards a 2-1 buy down and you're dead set on doing that 2-1 buy down, then don't feel the need to raise the price. If they're saying no to the credit, then if the lower payment is that important to you, and you don't think that rates are going to be able to go lower in the future, you're going to be able to refinance when rates go down, and you want to take that, then you could go back to the seller and say, hey, listen, I'm willing to offer you a little bit more in lieu of you giving me that credit. And in theory, that should work. So really depends on what you're trying to accomplish there. But I would start with the idea of trying it without raising the price just to see what kind of response you get. But again, it depends on your market, how much inventory, all that good stuff. Josh got a question here just asking, is it better to get an FHA loan today? We showed FHA rates. In fact, I'll just kind of put those back up here. This right here says FHA rates are at 7.4 today compared to 8%. So the idea here is that, is it better to get an FHA loan today because rates are lower? And if so, when would you, refinance? Let's eliminate the last part. So let's say 7.4, once you add the mortgage insurance onto it, you're basically at 8%, right? I mean, assuming, you didn't have to get mortgage insurance with 30-year fixed, it's more or less the same rate. But,
well, it's not the same rate because they're not asking on a 20% down loan, should I do FHA? They're probably looking at a 5 or a 10% down. So you have to look at your interest rate with your credit score plus your mortgage insurance on a conventional loan, and then compare that to FHA. For most people putting less than 10% down, the FHA is going to have a much lower monthly payment. The thing you got to be aware of is with that FHA loan, you have a 1.75% upfront mortgage insurance premium. You don't pay it out of pocket, but it goes onto your loan, so you have less equity. So it's important that you're working with a mortgage professional that understands that can pencil it out, that can show you the pros and cons of each one, because there's not a right answer. But in terms of lower monthly payment, FHA is more attractive than it's ever been because of the spreads in interest rates, because they reduced the mortgage insurance a couple of years ago, and it's very competitive with conventional loans. On top of that, the government, in terms of the FHFA, has been changing and increasing loan level price adjustments for conventional loans. So other than 10% plus down, 780, 800 credit scores, it's more and more attractive.
Again, we almost made it. We almost made it back to the end of the show. A first peak and at the end. Yeah. All right. Good stuff, Josh. Good stuff. We addressed these questions. We don't really have a lot of new stuff in there, my friend. So, Josh, what's on your mind right now?
Well, I was trying to take a screenshot of the thing where StreamYard is saying my connection is unstable, so I can send it to our friends with our business class internet at Frontier and find out why my connection. It says if you're on Wi-Fi, please consider using a hardwired connection. Well, that's interesting because I am on a hardwired connection.
As am I.
Yeah,
I'm hardwired as well, and having the same issues that you are, and Burn It Up asked the question about computers. Do we have new computers? Josh went out and bought basically a supercomputer. I mean, it takes the entire
a brand new i9 with 64 gigs of RAM. It's about as fast a machine as you can put together.
And we still can't stream. Mine, on the other hand, isn't quite that, but it's purchased within the last 12 months, 24 months, something like that. So in theory, it should be able to handle some basic online streaming. We're not gaming over here. We're just trying to talk to the internet, trying to talk to you guys. That's all we're trying to do. 559. How many people have liked this, Josh? 55. Only 55 people have liked us tonight.
One out of
And
three.
I guarantee you all of those 55 aren't even in the room, and there's 162 people watching. It's disappointing. I think it might be because you're on the show every week, Josh. I might need to change this up. Maybe I get more likes if I change you up and go somebody cuter, you know?
That's impossible. You might find
Somebody,
but no one
somebody better
no
looking might help the views, might help the subs. But no, in all seriousness, if you found any value tonight, help us out. Hit that thumbs up. Subscribe to the channel, Jeb Smith, if you haven't done so already. If you haven't listened to the Educated Home Buyer podcast, go check that out. Oftentimes, you guys want to talk to Josh about doing financing or get in touch with a lender. There's a link scrolling at the bottom of the screen right now. That link will get you in touch with a lender, get you in touch with Josh if he serves that state. If not, it'll get you in touch with David, one of our other mortgage pros out there. Somebody, personally know, like, and trust that can guide you through that process. And if you need a real estate agent, that will also get you there too, and it'll get you in touch with me. So that's the easiest way to connect with us. Josh, it's 6 o'clock. Should we answer another question, or should we go bye-bye?
Well, we've got a great comment here. Wesley is saying that it's overkill on my computer. I am not mining Bitcoin. I just believe in overkill at all times.
Maybe he's killing the internet. Maybe the computer is so strong that the internet
just drawing
can't
in
support
all of the juice.
Yeah, that's the problem. But I would say that's the problem. But then I'm streaming. I don't typically have this problem if I'm on a Zoom watching something else. I will say that. I don't know if it's the time of day.
You think it's StreamYard's problem?
I don't know. I'm trying to think when we do the podcast, because we film it in Riverside. Do we have these issues? You do the you do the thing. Do we have?
No, it
occasionally.
Does. Yeah, it does. It goes out in Riverside, so it absolutely does.
Okay,
but Jeb, we had a good question here, a good one to end the night on. We're going to give our friend Nicolas Cage the final thoughts on the night. Jeb, do y'all think prices have bottomed out in most major markets?
Bottomed out? Well, you're going to continue to see year-over-year increases just based on the data. So for the next couple of months. Now, bottomed out, or what are we saying? Bottomed out, is that the bottom or is that the top? What are we saying is the bottom, Josh?
Well, bottoming out is the bottom. Topping out would be the top.
I know, but it's YouTube, so you can kind of make the words whatever you want them to mean. I don't think we've bottomed out. I think, rates stay high. You're going to see things move sideways and down in some markets for sure. Rates improve. Maybe that's a bottoming out, but they have to improve quite a bit. I think you got a lot of sideways movement in here, and it's just going to be a grind for the foreseeable future. Anybody in mortgage and real estate are going to grind. And homeowners, home buyers, you're going to grind. It is what it is for the time being. I don't see a lot changing unless some major data comes out, or you got war escalation, something major, something big has to happen in order to see anything happen in any meaningful way.
So just remember, these are educated guesses. Educated because we've both done this a long time, have feelings on what is likely to come next. We go back to the top of the show. We talked about seasonality. Because rates have spiked, because we're going into a low part of the year, I think we're likely to see some of what we saw last year. For the next couple of months, there's momentum carrying into the data that will have month-over-month increases. I think we're going to see through the winter months, so December, January, likely to see some negative year-over-year numbers. My expectation is that rates will improve. Probably 4, 5, 6 months out, which puts us right at the beginning of the year, right when people get back into the market. And we're likely to see a replay of what we saw last year. We saw rates dip at the beginning of the year. People come out of hibernation around Super Bowl time and get out and buy homes. So does that mean 7, 8, 10 double-digit percentage increases? Absolutely not. But I think the year ahead is going to look a lot like this last year, a soft winter, some thawing and improvement in the spring. And at the end of the year, you're going to look back and see minor appreciation. But again, educated guess based off of experience. And the most important thing we can do is sit here and analyze the data. As for today, everything bearish in interest rates. If you're in the market, make sure you're locked. And let's keep watching, see for some slowing data in the economy and see if that trickles down into interest rates so that Jeb can refinance next year.
Anyway, appreciate you guys, all the support. Again, appreciate the likes and follows, the subs, all that good stuff. It does help. And we'll be back next Wednesday, guys. Until then, au revoir.
Au revoir, Pee-wee.